Okay, what is up, traders? What's up, tycoons? Super excited for today's video. We got to talk about one of my favorite indicators, right? Now, this isn't your typical indicator, something like an RSI or MACD. What we're actually doing is taking a look at credit spreads. Now, yet again, this is not what you think, okay? These are not credit spreads like options, right? These are in the form of bonds, okay? And so what we have on top is going to be the S&P 500. And then on the bottom here, we've got a ratio chart of IEF and LQD. Now we'll break down what this chart is, why we're looking at it, what these lines mean. We'll also define credit spreads for you guys, define what the IEF and the LQD is, what those are, so you can actually understand what we're looking at. And then we'll talk about credit spreads a little bit more, right? It's not really so much a measure of market breadth, but more of a form of determining if the market is risk on or risk off. Okay. So it's a really good indicator. It's something that I like looking at along with market breadth instruments. And I've got a series, that I've started putting out, going over many different market breadth and ways to measure risk on and risk off. So you guys should definitely check out that playlist on my channel. And then we'll revisit the chart here and really just wrap things up and give a nice summary. Okay. So as always, the content provided on this channel is for informational and educational purposes only and is not intended to be relied upon as legal, financial, or investment advice. So be sure to read through the disclaimer. And if you're brand new to the channel, I actually started a completely free newsletter for you guys called Investment Intelligence, giving out free finance content, free valuable trade ideas. I try to sprinkle in 1 to 2 free trade ideas a week, and this is what they'll look like, right? We'll highlight the chart conditions. We'll show you the actual chart itself. Okay. And many of these trade ideas have worked out very well. All right. There is a website associated with it. So you can go back and read some of the previous newsletters. If you take a look just at some of the most recent ones, they turned out really well, right? Teladoc went up over 14% afterwards. PayPal went up over 10% afterwards. Rivian went up over 40% afterwards. And even the most recent one, RTX, which is Raytheon, we talked about the cup and handle. You can see how well the stock just completely fired off. And we have people in the Discord hitting me up saying, hey, do you still have RTX? My January call options are up 88%. They ended up going well over 100% even. And so if you do want to join the Discord, you guys can actually get in right now for just $1. Okay. Promo code JAN24. Okay. So that's capital JAN24. That will get you into the Discord for just $1. Okay. I'm going to be running that promo code pretty much all January. So feel free to use it. Tell other people about it. You can basically see all of the different trades that we've been in, right? Excess, Palantir, Chewy, PayPal, we talked about that one on the newsletter. Teladoc, we talked about that one on the newsletter. Toast, we didn't go over Toast in the newsletter. Carnival Cruise Lines, we didn't go over Carnival Cruise Lines. SoFi, so if you like my analysis, right, you like my videos, you like the analysis in the newsletters, and you want to get access to all the different stocks, all the different analysis trade ideas that I'm looking at, as well as custom scripts, indicators, and many other resources, well, feel free to join. I would love to have you guys in there. Now, we'll go ahead and get going on the video now. And as I mentioned, we've got the S&P 500 here on top, and we've got a ratio chart of IEF LQD, okay? Now, what are credit spreads, okay? Well, a credit spread is the difference in yield between two bonds of similar maturity, but different credit quality. So credit spreads reflect the extra yield that investors demand for taking on the additional risk of a bond with a lower credit rating compared to a risk-free or a less risky bond. Wider credit spreads indicate that there's a higher perceived risk of default on the lower rated bonds, while narrower spreads suggest lower perceived risk. They are a critical indicator in financial markets because they provide insights into the overall health of the economy and the risk sentiment among investors. So IEF is going to be your iShares 7 to 10-year Treasury bond ETF, and it represents the performance of intermediate term U.S. Treasury securities, which are considered risk-free assets due to their government backing. Okay, so when they talk about a lower credit rating compared to a risk-free or less risky bond, right? That's going to be your IEF, okay? Risk-free, quote unquote. Now you have LQD, which is going to be your investment grade corporate bond ETF. So this tracks the performance of U.S. investment grade corporate bonds, which carry higher risk and yield compared to treasuries due to the credit risk of the issuing corporations. Okay, so risk-free / less risky and more risky right here. And so typically you'll see that the corporate bonds will pay a little bit more of a higher yield because of the risk associated with them. And then meanwhile, government bonds will pay a little bit less because they're technically risk-free. Now, credit spreads are not a measure of market breadth. Market breadth refers to the extent to which movements in a market index are broadly reflected across the individual securities that compose the index. So it typically involves metrics that compare the number of advancing stocks to declining stocks, new highs to new lows, or volume flowing into up stocks versus down stocks within an equity market. Market breadth is used to gauge the overall health of the stock market and to identify whether a market move is widely supported by individual stocks. Now, credit spreads, on the other hand, are an indicator of the perceived risk in the credit market. They measure the difference in yield between two bonds of similar maturity but different credit quality, such as between corporate bonds and government bonds. So credit spreads reflect the additional yield that investors demand for bearing credit risk associated with lending to corporate borrowers as opposed to risk-free government borrowers. And the way that I really like to look and use this, okay, is to justify moves, all right? And figure out, if a move in the stock market is justified by and being reflected through credit spreads, right? And so that's why we have the S&P 500 index on top. That's our SPX, and that's why we have our ratio chart down here, okay? And so you can see that there's different times. There are some periods such as this little one right here I highlighted. Where they will move in the same direction, right? You can see we have a high here and a higher high here, and at that same point we have a high and a higher high again. So there are points where they will move in the same direction. But overall, you want these to move in opposite directions, right? So we see as the S&P 500 is going up, our credit spread measurement is going down here, okay? And so that makes me feel good about this rally in this moment, right? And if we start to see an uptick in this, okay, you can see that that is when the stock market actually starts to decline. And you can see this really dramatic move up right here, and you see a really dramatic move down here or lower in the stock market, right? And so, this is one thing that it's not necessarily going to, tell the future or be some crazy, fortune telling crystal ball thing, all right? But when you ask a lot of people on Wall Street and you ask a lot of investors, okay, people who are serious, this is something that they look at, right? If they were to only have one economic indicator, right, and one thing that they really wanted to look at to tell whether or not the economy is in good shape, or whether markets are risk on or risk off, all right, what their view is on the economy, they would say that they want to look at credit spreads, right? And so that's why we're looking at this. And you can see this period here where the stock market absolutely just ripped here recently, and we see our credit spread instrument just absolutely tanking here, right? So we feel really good about this rally while this is happening here at the moment, knowing we can just clearly see that the market is clearly going risk on, right? When this is going down, the market is more risk on. And when this is going up, this is when the market is risk off. And that's when you see the market starting to pull back, right? So credit spreads are best described as a risk sentiment indicator or a measure of credit risk premium. They can be used to assess investor confidence and the economic outlook, as wider spreads typically indicate higher perceived risk and uncertainty, while narrower spreads suggest lower perceived risk and more confidence in the economic environment, right? So as such, credit spreads can be a leading indicator for other markets, including the stock market, and are closely watched by investors and analysts who seek to understand the risk dynamics in the financial markets. They are particularly important in the fixed income market, where the cost of borrowing for corporate entities can significantly impact their financial health and investment decisions. Now, that's going to wrap up the video. Okay. Hopefully you guys enjoyed it, learned something new. Don't forget to sign up for that completely free newsletter, guys. There's a link in the description. You can sign up for that today, get access to that free valuable content, as well as those free trade ideas. You can also sign up for the Discord. Remember, promo code JAN24, just all caps right there. That'll get you in for just $1, right? And, after your first month, it goes up to $10 a month, which is still a bargain, guys. I mean, it's less than a cup of coffee a week. And, I'm sure your girl has you ordering $8, $9, $10 Starbucks orders whenever you go. So, just to put it into perspective. Now, you guys can also check out Simply Wall Street. They are a sponsor of the channel, right? And I do a lot of technical analysis and macro data on this channel. But if you're someone who's more into fundamental analysis and, you're not a pro at fundamental analysis, well, Simply Wall Street has their pros doing the work for you. And it's a really, really great platform that I used for a while before they were a sponsor. And now I'm definitely glad to have them. So there is a link in the description as well for Simply Wall Street. If you guys are into fundamental analysis, it's a really great platform. You can look up whatever stock it is you're interested in, and you'll be able to get a really great deep dive. You can see insider buying, insider transactions, as well as a plethora of other things. And if you ever feel like you just need a little bit more, right? Like you need that one-on-one personal touch, you guys can head on over to my Ko-Fi page, click on the commissions tab, and in there you can actually book a 30-minute or 1-hour session with me. I do private coaching, little one-on-one coaching sessions all the time. So if you ever feel the need for that, okay, check out the Ko-Fi page using the link in the description. There's also a cool little buy a coffee button here, basically a way to leave a tip or donation for all the free valuable content I do put out there. So if you ever feel like you want to give back or do a little tip or something, Ko-Fi would be the place, essentially to do that. Now, thanks again for watching. Smash the like button, subscribe to the channel for more, and I'm out.